Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long-short report covering all asset classes.
Yes, it's that time again. I need to give out a YouTube video update. I know there are long pauses between my updates, but that's just how it is. Sometimes the market gets so wacky that we are so concentrated on our trades and positions and what to do next that we just miss out on doing the video. And then it reaches the end of the day, you're exhausted and you just let it go. So all the thoughts are there in the mind. Yes, I should talk about this or talk about that. And then eventually I don't end up, putting this out. So anyway, here it is, 28th of May 2022. We've ended expiration for the month of May. And one of the things that I've spoken about, and this will still get debated for a while, is that the put call ratio was very, very low for this month. And if the put call ratio is very low, what does it mean? It means that there are more calls outstanding than puts. And that simply puts downward pressure because long positions are equal to calls outstanding. Now, of course, someone else came and debated with me on Twitter that no, it's the retail investors who are selling calls and puts. Let me just tell you the number. They run into lakhs of crores. Okay, it's not even, it used to be 10, 20, 30, 40,000 crores max till 2018, 19 at all the tops or bottoms. The market used to have some 40, 50,000 crores net call outstanding. Now it is running to like 2.8 lakh crores we saw in the mid of this month, and then it started to cool off from there. And so that's a huge number. It's not just retail selling that amount of call options. Buying, yeah, possible because they only pay premium. But when you sell, you need to have margin. So it takes a lot more to do that. And so he pointed at the data sheet saying that, you can see the large amount of open interest on the client list. By the way, client is not only retail. It includes corporates, it includes HNIs, it includes even your, yes, operator. सबको पसंद है, ऑपरेटर जो करता है वो ही करने कहा है. So that is your operator. So all of their positions, unless the operators are running through some corporate book or some other account, but that will also indirectly end up showing here because there are only 4 categories, right? DII, FII, client and prop. Now unless if you go prop means like broking companies, finance companies with their own desk and they're reporting it as prop to the exchange. So it's a very small quantum. If you see out of total open interest, the prop book is very, very small. The largest components are FII and client. DII has slowly grown now. Initially, it was also not even a meaningful content. So and then when you look at that, you understand something. Even if somebody is selling a call, what is it? The seller of a call is short. Okay, he's bearish. The seller of a put, he's bullish. Whereas the buyer of a put is bearish. So when you're actually saying there's a net long or short position in the market, you have to actually look at all the positions. Long meaning he could be long futures, he could be short puts. Both are bullish ways to express a bullish sentiment in the market. So when you're really trying to measure sentiment, which is the whole idea of doing this analysis, you want to know whether everybody is bullish or bearish. Okay, not your 5 friends. 5 दोस्त लोगों ने तेजी बोली तो तेजी सब लोग को तेजी लगती है मार्केट में. If that's how you're approaching the market, तो फिर God bless. So when people come and say everybody's bullish, everybody's bearish, then I say, how did you measure that? Do you have a data point? Then if it's one of the market data sets, like the NSE data, fine, great. But then are you calculating it properly? Are you looking at the data in the right way? And so if you're looking at it in the right way, you'll have the right outcomes. So anyway, what I said, in fact, even in the Spaces event that I had with Prashant, he was asking me, when will you get a tradable rally? I said, even if the market's bottomed here or bottoms, a couple of 100 points lower, the tradable rally might not come in May simply because of the high outstanding in call options, and the options market. So that will keep pressure till the end of the month. That was the view. And that's what's happened, even though it didn't fall and break the March low. I thought it would. It made a very close attempt. In fact, I noticed only 2 days before expiration that on a closing basis, you actually did break the March low. So we didn't go intraday below it, but the closing level was lower than where we were in March. So in that sense, we sort of did that. And Of course, I'm not taking that as a claim that you broke the March low. No claims, because I thought you would have broken it even intraday. But the point is that when we study technicals and charts and we're looking for divergences, then getting a lower close, all divergences are studied on closing prices. And so if you have a data point which is like, what if your advanced decline ratio is higher than where it was at the March low, or what if your put call ratio is higher, or something is higher. So we had at least a couple of data points. AD was one of them, and I think probably the FII short positions, which were very, very high at the beginning of the month, had actually reduced, and they are less than what they were in March of 2020, and probably in March of this year also they had gone short, and this time I think the positions were slightly different. So you had sort of these small positive divergences building up, and because of that, I think we could have overlooked that the market was reaching that extreme point. So 2 days earlier, so I put out all this entire sentiment chart data at Indiacharts under the long short update section just a day before expiry, that there are a couple of indicators that we can say the market may bottom. But of course, I waited to change that view till the last day. In fact, we thought once it was bouncing back early part of the week, then it changed down again. So I thought it'll break the low just before expiration, and then it turned up again. And so that changed. So finally, we had a setup where we were looking at a potential bounce back that will retrace this entire fall from the April top. And now, of course, this is post expiration. So post expiration, once all the long shorts, whatever it is, all expired, all gone out of the window. Now we are starting a new series. So then it's light. And because there are very few buyers, you're getting a jump in prices. I don't call this short covering, because sab to expire ho gaya. Bacha kya? Short covering ke liye you need a short position. Na expiry ke baad kya short position? Unless you rolled it forward and there was a huge rollover happening. I don't study rollover data so closely, but anybody of you can verify that were a lot of shorts getting rolled over into the month of June. Probably not. And that's the alternate reason why markets tick up, because there's no selling pressure. तो ये तो हो गया, selling pressure is gone for the time being, but question is आगे क्या होगा? Has the narrative changed? Rohit, did you think it was a bear market? Now do you think we are back in the bull market? But then if the market was only going to fall to 15,800, I didn't turn bearish in March. Why should I turn now? After all, the VIX did not even make a higher high. So so you really have to understand the reason behind my doing that. Why did I stay bullish for so long, and then why did I give up? And then if I gave up, then have those reasons changed? And it's going to take a while for me to confirm whether those reasons have changed. So yes, I will miss out on saying that the worst is over if it is really over, or else maybe the worst is really not over because those reasons have not changed. So I'm in that fix right now. And during that fix, what we'll end up doing is we know how to trade the markets, right? It's not that we don't know. We know how to use momentum indicators, Bollinger Bands, and the Elliott Wave theory to get a forecast. And the forecast, if it is wave B bounce, we can trade a 50-60% retracement. So we are never out of the market. There's always an opportunity somewhere. But the real thing that we'll be watching out for is what is going to happen on the currency market and on the bond market. These are the two fronts. I've talked about it even in the weekend with Indiacharts. These are the two places I will watch for risk as far as the specifically Indian market is concerned, because the USD/INR broke past the 2020 high, and it is very steadily holding above that. So having done that, I think it's an interesting point. Around 77, I think it was, or 76.8 that we really had made in 2020, and we are above it. And if we're doing so, are we setting up for a much higher move? In fact, monthly charts are showing much more strength for the USD/INR, because the monthly momentum is swinging higher and the bands are expanding again. So that setup on the monthly tells us that the currency could actually weaken a lot more. And it may sound logical, because in the sense the government says they are doing a lot of stuff to bring down inflation. They are brought down petrol prices, they put duties on steel, they've tried to pull down exports of sugar, wheat. Now all of that is good in a way. It also means it brings some pressure on the government's budgetary expenses, and that means they need to borrow more, so bond yields will spike up. But if bond yields go beyond 7.42, they'll break out of a 6-year, 7-year falling channel, and that will sort of confirm one of the reasons why I gave up, because I was not expecting bond yields to go above 7.25%. That was my top expectation. And so I was expecting yields to rise last year, but only till 7.25. And the moment they broke out of that, which is 61% of the last fall, I got a little nervous. And now we are at this second breakout, which is a much more bigger breakout and confirmation that the downward trend changes to an uptrend. And that's at around 7.42 in the month of June. If we start trading above that, then I think we have enough reasons for trouble on the rate side to continue. So if interest rates continue to spike up, go above 8%, 8.5%, whatever, that would be one risk. The other would be a weakening currency, which would be caused by all of these factors. But also one more, that, why would rates go up? It would be only because inflation is still sticky. And the two signs that inflation is sticky from the two most important data points that any government would watch to deal with inflation is food and energy. And food and energy prices are not coming down. So we can bring down steel, we can bring down cement, sugar, which has become a oil substitute, but we are really not able to bring down oil prices. So crude is remaining high, elevated, whether for the war reason or whatever. And then you just scan through agro commodity prices. You're not really seeing them come down the way we have seen probably copper fall or aluminium, and many of these metal prices fall. So we are not seeing that in, say, wheat, rice. We're not seeing it in sugar, coffee. All of these prices are just holding on. And so that's a completely different ballgame out there when we look at commodity prices for food. And if you start watching food inflation as a risk for raising interest rates, and then you're looking at copper and trying to think inflation niche aa raha hai, so then you got all mixed up. And that, so if you're looking at that top line inflation data, 8% became 7.7, and so that's a good reason. But oil prices are not coming down. So then we are really talking about the inflation rate versus the price of the underlying commodity. Because of the underlying commodity has gone up so much that it's eating into savings, then the rate coming down doesn't change the price or the savings pattern. I'm still paying the same amount for the bread. The rate just came down because of a base effect, because it's flat and prices are going up slowly, so slow, faster and then slowly. And so you got an ROC reduction, but no reduction in prices as such. So that sort of then is anyway a contraction in money happening right there. And I'm sure some of you were listening to all this saying, hey, Rohit, you said exactly the opposite of this in January. You said inflation is good for equity. Of course, inflation is good for equity as long as governments overlook it with their eyes closed, like they did from 1940 to 1950 in the US, which is the big example Ray Dalio gave for the markets being bullish a couple of years back. And why the MMT whole thesis was formed that, governments can keep spending money along with the Fed printing money, and you keep inflation below 4%. So you'll keep negative real interest rates, inflation will eat into the debt, and the value of debt will come down, and your debt to GDP problem is solved. Great. The problem is inflation goes above 4% to 8%, and boom, you have a completely different problem. Governments have to step in, raise rates, take some action. So for a while, it looked like they wouldn't take action. Even now, there are skeptics out there, like I was till probably April, that will the Fed really do it, or will they turn? Bond markets already collapsed. And so I think that crowd is still there waiting for the Fed to pivot. And which is why now this bounce that you're seeing in the last few days gets a big question mark in front of it. Because if you're in a bear market, it should only be a small bounce and sell off again. Because if the Fed can't really change track their rate hikes and tightening of the economy, even if they raise slowly, in any case means, and they're going to start tapering from next week. Don't forget, the tapering starts from 3rd or 4th of June. And so this is the last week before tapering hits. And that will slow down the economy. It can or may not mean recession, but people are already saying Europe and China in recession, and that is true. Often with a lag, 6 months later, you end up seeing US in recession. This is just the views of many others I listen to. But we want to see data, but I think the risks are there. The point I'm trying to make is that we are not able to take the risks of all this happening off the table. But you are at a point where markets are looking like, have we completed A, B, C in the NASDAQ? Yes, it looks like, because C equal to A in terms of Elliott wave sense, the way we see it, the minimum target has been achieved. And from there, it's bouncing back. So you're getting the bounce back in the NASDAQ, from achieving a target. The question I'm trying to ask is, will that target get exceeded? Will wave C extend? And that depends on whether the economy continues to slow down and earnings degrow, and which means we are already in a bear market. And for all of that to not happen, the Fed would have to change stance. And so this fight between Fed won't, they'll pivot, they won't, they can't go through with it. So I think that argument went on for a while. Once the market, specifically commodity prices, started to roll over, I backed off and I said, I'm not fighting this fight anymore. I'm done with fighting and saying that, inflation will work for the market. on the upside, because it did for a while. It did till April, and April you saw new highs in the Nifty Metal Index, Power Index, Energy, Oil and Gas, Autos. Autos did not. Okay, they almost came to a double top, but so many of these sectors which are really impacted directly by rising prices, just played. And now if that starts rolling over, then do we really have that game? So why do we really want to fight that fight as to when they will do it? Why not just wait? Let them do it. Let them change stance. So till they don't change stance, until we don't know that they are doing so, or at least they're indicating that they're doing so, the risk is that you can walk into a recession, and that can be negative for equities, and which is why equities might remain volatile. You might get these big rallies on hope, and then if nothing is really announced by that point of time, and like I said, food and energy prices are elevated, then and I wonder if they've been watching real estate, because US real estate is not coming down. My brothers in the US, California prices are not budging. I don't know if California is the target zone for the government, but even then prices are high, but what they really want to bring down is rents. Now, can rents come down without prices and all? I don't know. I don't understand the US market. And so, but what I understand about reality is I think there is a linkage. Of course, you can get rental yields to become very, very low, like in India. So when prices go up a lot, rents cannot go up beyond the point that you can afford. But the problem here is something else. Rents has been going up because prices went up so much that every landlord hiked rents, and now people are finding that eating into their budgets, and so they are all upset with the government, and so the government needs to bring down prices of real estate which are in a bubble, because they want to bring down rents for the average guy on the street. And so if that is another target apart from food and energy, then we have still got a long way to go. So really understanding what are the data points that the government will really attack on this, and how long they will remain on this rate hiking cycle, is going to determine how markets play out from here and forward. And if I continue to just look at the size of the rally we saw in the small cap index, it's as big as the rally that we got in 2010 after the 2008 bear market. Then in 2016, 18, all the way to 2018, I think that run up also is the same size. And each of them got followed by a 2-year plus bear market. Okay, and the only time we didn't get a 2-year type bear market was 2008, when everything just collapsed within a year. I mean, so there are only two ways this happens. You get a swing straight down, vertical, or else you get this slow, painful, 2-year long cut, fall, rise, retracement, sell off, blah, 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 blah. So which one are we in? Sharp or slow and concise? Let's see. But definitely after making that big high, the small cap index has fallen in 3 waves. We can argue ABC is done, but historical bear markets show that an ABC is followed by an X and then another ABC, and that's all we are trading for right now on this bounce into next week, an X wave. That is a tradable rally that I thought was coming in May. I thought in May it would come in June, but it comes right after expiration, and that the idea was after expiration. So we are getting it, and the way we are going to be looking at it is that it should be a bear market rally. If it signals otherwise, and if my other macro data points change, I will change. But till that point of time, let's just stay with this. And that's what we are doing in our everyday updates, trying to track and trade each and every swing up and down, because you're in an up and down market. You want to be bearish, then you want to be bullish, till the retracements only. And so when you're on the long side, I would also bet less than I would bet on the short side, because counter trend bounces are sharp, evil, but especially in stocks, the rotation is such that you could just end up choosing the wrong stock. The market retraces, but the stock you chose goes down 15%. Deal with that. But let me leave you with one last offer, and this offer is from Chavan. To everyone who's been and wants to be a subscriber long term, 1 year to 2 years. We've put out a 10% discount till the 3rd of June. Even if you have an existing subscription, it will just get added to your existing subscription. The prices are just lowered directly on the website, so you don't need any coupon code or any particular link. Except if you're on the iOS app and you're trying to do it, then you just contact us. Otherwise, you should be able to renew your subscription or add this subscription at the lowered price over the next couple of days. So that's it from me. That's the final input, and see you next time.